Welcome to another amazing episode of Raising Private Money. I'm Jay Connor, your host, and I'm so excited decided to join us today because this is the podcast where we talk about raising private money for your real estate deals without ever having to ask for money. Well, my guest today, in fact, I've had him on the show before. He's amazing. I love this guy. Well, he's raised in the millions of dollars in private money. His expertise, in addition to private money, also includes creative deal structuring, wholesaling, flipping, landlording, and lending as well. So he's been involved in thousands of transactions. What really sets him apart is his love for people just like myself. Well, as I mentioned, he has co founded a private lending company, also a real estate acquisition company, and he hosts several national mastermind groups called REI Circle of Trust. Now, as part of his giving back, he actually founded and ran the Central Wisconsin Real Estate Investors Association, which later merged with the Wesco RIA. Well, something interesting on a personal side, he's an adrenaline junkie at heart. He grew up racing stock cars and skydiving, all kinds of good stuff. Well, we're going to dive deep here in just a moment to learn how my guest has raised a lot of private money. In just a moment, you're going to meet my guest, Derek Dombeck, right after this.
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Connor.
Well, hello, Derek, and welcome back to the show.
Thanks for having me again, Jay. It's always a pleasure.
Absolutely. Absolutely. I love hanging out with you. You've got a giving heart, a servant's heart, and pretty smart real estate investor, too, I might add. Well, for the sake of those that have not met you before, Derek, here's the question. And you can answer this as quickly, as short, or as long as you would like. And the question is, who is Derek Dombeck?
Well, I am just a humble servant from central Wisconsin area. I live in the upper Midwest. Started off like most people, fixing up a couple properties, and over the last 20 plus years, that has just evolved into all the creative structuring and the deals I've screwed up, quite frankly, and learned all the hard lessons. And now I get to teach people based off of my mistakes, which I love doing. Have my own podcast called The Generations of Wealth. And at this point, anything I do to give back and expand my network is my goal.
So when you talk about creative deal structuring, that could mean a lot of different things to a lot of different people. So what's your definition of creative deal structuring? And then let's dive into that a little bit.
Yeah, I think a lot of people think that buying a property subject to or on a land contract or seller financed, all these things is creative. To me, that's just another way of financing. So I define creative deal structuring as using all of these different tools and strategies to solve somebody's problem. So I might do a deal where I buy it sub to, the sellers maybe carry back a second mortgage, and I'll bring in private money on a participating note to rehab the property, and then ultimately lease option it to a tenant buyer. I consider that a creative structure because we're using all the tools, or as many tools as we need, to solve a problem. That's the short version.
Right. Well, so just to make sure all of our listeners here understand what you're talking about, when you say buying a property subject to, what does that mean?
Typically, that's going to be subject to existing debt, and that may be bank debt, that may be private debt, but we're stepping into the position of the seller, making their payments for them on their behalf. However, they are still, if it's institutional debt, they are still on that as a personal guarantor. We're not assuming that debt. We're just, taking over their payments for them on their behalf. But we get the deed. We own the property.
Exactly. Well, who in their right mind would agree to sell you a property and agree to leave the mortgage in their name and trust you to make the payments?
Well, that is the key to figure out what their challenge is. And I do that in a lot of different ways through my negotiations, which I will define a negotiation as just a social conversation. But through that conversation, what are their needs? And let's just assume that they have maybe some financial troubles. Maybe they're in foreclosure. Maybe there's some medical bills. Maybe they lost their job. There's so many different reasons that somebody could be in financial turmoil, and the property could be perfect. It could be turnkey. So if I step in and let's just use a foreclosure example, somebody's behind on their payments. I'm able to come in, catch up their payments, start making those on time. It fixes their credit. It stops the foreclosure in that example, and they move on. If they have equity in a property, we may pay them out either all cash or we may pay them out over time. That's just case by case. But there's a lot of people that are absolutely benefiting by us taking over their debt.
So, what it sounds like is a person that would be willing to sell their single family house specifically, subject to leaving the note in their name, is somebody that is stressed out and needs debt relief for whatever reason.
Correct. And in some cases, they may not even have any financial turmoil. It may just make more financial sense to keep that debt in place and get paid out the rest of the purchase price over time. Quick example might be a landlord that doesn't want to take a chunk of money because they're going to end up paying capital gains taxes or put them into a higher tax bracket this year. So stretching it out using an installment sale as well as taking over their existing debt could make a lot of sense. And they weren't in any kind of financial turmoil with their actual loan.
Now, one of the example that you gave about creative deals and creative deal structuring was actually combining two strategies together simultaneously to make that particular deal work. So the example you gave was buying a property, single family house, subject to the existing note, but then you included in that example borrowing private money and giving the private lender a second lien position or a second mortgage, a junior mortgage in second position to either bring payments current. You can use that cash for bringing it current. Maybe there's some renovations or whatever. So when a real estate investor that's structuring that type of deal, combining subject to the existing note and then having a private lender in that second position, what what advice would you give to either red flags or warnings about doing that combined strategy to where everybody's protected, specifically the private lender?
Yeah, so I can tell you about a deal I'm doing currently. We're buying the property, and it's not subject to. It's actually seller financed. Um, well, actually, let me tell you a different story, Jay, real quick. I'm closing on a property in 2 days. This person owns the property but has a hard money loan against it. So we're buying that one. I'm bringing new private money to pay off the hard money loan. So that private money is going to be in first position. The seller is going to carry back a second position note, which is a participating note. So they have a locked in amount that they will get. However, when I resell the property, I get the first $30,000 of profit, and any profit over and above that, the seller will participate in. So he ultimately can make more after I sell the property. So that's an example of not subject to, but bringing in new private money in first, seller in second. A quick example of taking over subject to and then putting private money in place. I bought a property subject to bank debt of about $50,000. I gave the sellers some cash at closing, and then they're taking payments in second position at 0% interest. And then I actually put a third position, private money, in place to rehab the property. And that third position, why would anybody go into third? Because we made it safe, but we also made it worth their while. We structured that as a participating note, paying the private investor 6% interest only on a quarterly basis and 10% of the net proceeds when the property sells. And that is in his IRA. So ultimately, he gets double-digit yield, but I get a smaller interest payment while I hold the property. So it's safe for all parties because that was completely leveraged. I shouldn't say completely. That was leveraged up to about 80% of value. So there was still plenty of value in the property as well.
That was going to be my next question is when you have multiple mortgages or not even multiple mortgages, it really doesn't matter. How much of what I call an equity cushion? Now, let me define what I mean by that for the sake of our listeners. When I say equity cushion, I'm talking about what is that property going to be worth after it's renovated, if renovations are required, versus how much is being leveraged, how much money is being borrowed. Um, that's the equity cushion. In other words, we call it loan to value for the sake of our audience. Loan to value, what's the most that's being borrowed as a percentage of the after repaired value? What is your rule of thumb for that, Derek, that, protects your private lenders and everybody?
Absolutely. So if I'm just doing a straight up cash purchase flip and I'm bringing in private money to fund the entire thing, I max out at 65% loan to value of the after repair value. If I'm taking a property subject to, or there's seller financing in first position, and I'm bringing in private money on the backside or in second position, I will go up to about 80% if it's going to be held as a rental. There is rare cases where I actually do go up to 100% loan to value. That is going to be more along the lines of if the seller is taking a payment at 0% interest, and I can expand on that if you want me to, I may bring in my private money to provide rehab funds or even down payment money. So I just bought a property a couple months ago. Sellers were very stuck on their price. And I said, okay, that's fine. I'll give you your full asking price, which is full retail. But they agreed to a payment that was at 0% interest over a period of 8 years and a balloon at that 8 mark. And then my private money, I brought in, fully disclosed all the numbers. And he's in, again, I love using participating notes. He's participating in the upside, but he's also participating every month in the cash flow. And because I'm paying 0 interest every month, it's all principal. So my investor is getting a part of that principal. He doesn't realize it until at the end when he gets paid off. But doing 0 interest seller finance gives us the ability to make it safe for everybody.
And when you're doing a 0 interest finance deal, that it being 0 interest to you, I mean, the pay down on that principal loan amount comes down like super fast
Absolutely.
as compared to interest only, where it's not coming down at all, or principal and interest. The initial few years, it's not practically not coming down at all either. So, on these creative structuring of deals, you've mentioned 2 or 3 times about participating notes. So I haven't had many guests here on Raising Private Money that talk about using participating notes. So let's talk more about participating notes. How is that? How's the paperwork put together? And I mean, is it when you say participating note, is that language that's in the promissory note, or is there a side agreement? Is any of this on public record? How do you structure a participating note?
Yeah, I don't believe in side agreements, Jay. Everything is in writing. It's all documented for the whole world to see that has a right to see the note, right? The mortgage does not, mortgage or deed of trust does not see any language about participation. So that's on public record. But the note itself, you just write it and type it in the repayment portion of your note. and whatever the terms are, make it as black and white as possible. You don't want any disagreements in the future. So I just drafted the note for this week's closing that says seller will carry back this note for $25,000, and it's typed up to say, I, as the borrower, will get all of my money reimbursed that is actual expense before figuring out what the net profit is. I will get the first $30,000 of profit, and anything above that, seller and I will split 50-50. So it's just line itemed out just like that in the language. So you don't have to have any fancy documentation or anything in excess. If you don't know what you're doing, get legal counsel. But for us, we've done this long enough where we draft our own notes and mortgages.
I got you. So with this world of creative deal structuring, there's lots of ways to put a deal together.
Mm-hmm.
And of course, for someone to have variable ways, more than one way to structure a deal, first of all, they got to be educated on that. They got to know these different options they have. But when you're looking at a deal and you're negotiating with a seller, having that casual conversation, how do you decide which way is the best way to structure a deal when you've got so many different options to choose from?
Well, I literally came back from a kitchen table negotiation an hour before this show. And what I do is I map out multiple ways that they can do it, and I let them choose. And the reality is, whatever they choose, I'm fine with, because we're structuring it in a way that we're going to hit our profit potential. Often I can give them a lot more money over time than if they take my cash offer. So this woman, her name is Amy, who I was sitting down with today, the cash offer really isn't attractive to her. And I'm showing her that. I'm telling her, I don't believe you should take my cash offer. However, if she ultimately chooses that, I'm fine with it. But if you take this terms deal or this creative structure, you're going to put this many more thousands of dollars in your pocket. And if you do, actually, I haven't even mentioned to you on the show, but I also like using options and controlling property without ever taking ownership of it. So I presented that to her as well. I said, you could maintain ownership. We will put an option in place, and that option will dictate how we move forward with the deal. What do you get? What do I get? What are the timelines? And it's another way of creative deal structuring that is very underutilized. And when you want to talk about how does private money come into play with an option, perhaps I still need $10, $20, $30,000 to bring to the table. I can have my private investor be a part owner of that option. So we may not own the property. They may not have a lien against the property, but they own part of an option. Completely different way to get private money involved.
So really what you're doing is you're making multiple offers simultaneously for them to choose from.
Mm-hmm.
And would you agree that taking on this strategy of multiple offers, you get a lot more offers or deals put together than if you just made one straight offer?
Of course. And you're really not talking to them like they're not going to move forward. You're talking to them like, we're moving forward. Which one do you like the best?
I love that. Well, to get even a better understanding of this multiple offers, and I love this strategy, do you mind, since we don't have a name associated with it other than Amy, and we don't have a physical address of the property associated with it, do you mind sharing with the audience these actual numbers? And let's get a grasp and understanding of, okay, here's my first offer that you gave Amy. Here's the second offer I gave her. Here's the third option. And it'll be really interesting, Derek, to hear you talk about, well, here's the all cash offer, but this second one, well, here's the price, which is more, but it's a terms deal. Do you mind walking us through those examples?
I can. It's going to be a little bit hypothetical because we're still penciling that one out. But
Sure.
the property after repair value of the property is about $180,000. This is a 4-bedroom, 1-bath house in Wisconsin. So Midwest pricing for those your listeners out on the West Coast, East Coast, drooling over those prices. Um,
Well, now,
Now,
Derek, our California listeners, they can't even purchase an outhouse for
correct,
$180,000. So I'm
correct.
glad you clarified where this property is located.
Absolutely. But these strategies work everywhere, just to be clear. So my cash offer, which is just 65% of after repair value minus repairs, puts me around $100,000. She has $45,000 worth of debt on the property, and she's relocating to Alabama. And she already has a house in Alabama that she's purchasing in June. So she doesn't need this loan paid off in order to purchase that other house. That's important to know. Okay. Because if we were going to buy it sub two, how does that affect their future buying ability and their credit? So the cash offer, $100,000. The house needs about $20,000 in updates and renovation. If she takes a terms offer where I take over her existing debt and start making those payments, then I would make a payment to her over time. And she talked about a 2-year time frame, which is short. Okay. And I told her so. I said, if I agree to a 2-year time frame, I would want an extension provision built in. And I do want your listeners to hear this, because Jay, even though you agree to something short term, doesn't mean you can't have an extension provision today when everybody's getting along and happy. And here's how you do it. You just say, you know what, Jay, I don't think it's going to be a problem paying you off in 2 years. But if we have some kind of event that's beyond our control, like COVID, for example, and I'm not able to pay you in 2 years, can we just agree now that I can get another 2 years if I give you $5,000 cash towards the principal of what I owe you? 99% of the time, people will agree to that extension provision. So I just doubled what they want. I went from 2 to 4, or if they were saying they want 5 years, I can go from 5 to 10 with that simple question. So I
That's
really want,
that's a powerful strategy.
yeah. And they can't argue with COVID, presidential elections, possible wars, all these things. You make it graphic. And they're like, yeah, I don't want to have a problem either. Let's have that solved ahead of time. Okay. So she's talking 2 years. And I said to Amy, 2 years is a short amount of time. So my offer is not going to be as high because I still have to come up with a chunk of money 2 years out. So that's not going to be a lot higher than my cash offer. Now, if you're willing to go out 5 to 10 years, my offer goes up, but it's going to be based on, do you want to collect interest or not? And then I have to explain to them, what does that look like? Well, if a homeowner collects interest on an installment sale, the interest portion is going to be taxed at their ordinary income tax rate. Versus if they take 0% interest, everything is a return of capital. And if this is their primary residence, I don't give anybody tax advice, and I tell them that. And I'm not giving any of you tax advice, and I'm telling you that. But most people do fall within Code Section 121 on their primary residence, where they have capital gains tax up to a certain level where they don't have to pay it. So I can pay more. I can even pay above retail value and pay them 0%, and they keep more money in their pocket. That's the goal, right? That's what you want them to understand. You can keep more, pay Uncle Sam less. Okay. So again, I don't have those numbers worked out, so I'm going to kind of make it up a little bit, Jay. 100,000 on a cash price, maybe $120,000 if she wanted to collect 5% interest on the payments and I took over her existing debt subject to, or maybe the full $180,000 that it's worth if she'll take 0% payments and I cap my payment amount for all debt, including the subject to portion of the debt, at 45% of rents. So if she's agreeable to that, then I can pay her out at 0%. And I have no problem paying full retail, which most people, it blows their mind. How can you pay full retail or even above retail for a house? Depends on the length of terms and what the terms are.
So I want to dive into that a little bit more, because what you just said is exactly what 99% of my audience is asking right now. And that is, how in the world can you pay full retail or more than retail for a house? And you answered it with the 50,000-foot view, but I'd
Mhm.
like for you to drill down a little bit.
Okay.
So how does that work? I mean, if it's zero interest, you're still paying that full price or above retail. Talk to us a little bit more about how that can work and be beneficial to you as the buyer.
Sure. So the house we bought a couple months ago that the sellers are taking payments on, they wanted $260,000 for the house. So we agreed that they would get $20,000 down up front, and they would take payments at $800 a month at zero interest for 8 years, and then get the remainder balance at that time. Now, I can take that same house and sell it for exactly what I just bought it for on terms and charge a buyer bank rates, 6.5%, 7%, and make a spread, because if you put it into a loan calculator at 6.5%, the payment on a $260,000 house is about $1,500. So I could actually make, what is that, a $700 a month spread selling it for exactly what I just bought it for. And what's my capital gain? My capital gain is zero, right? So that is one way. The way we're doing that exact deal is they're taking $800 a month payments. We're leasing it for $2,000 a month. And the tenants are paying down my mortgage to the sellers. And it's just all math. You have to sit down and calculate it out. That 8-year mark, and I don't have the numbers in front of me, but the payoff is significantly less than what that property will be worth 8 years from now. But even if it doesn't go up one dime in value in the next 8 years, we've paid down that principal.
It's right at $80,000, right?
Okay.
So 12 months times 8, 9,600, call it 10 grand times 8 years. That's $80,000 of pay down you got. So how did you come up with the $800 a month figure that you offered to pay them 100% going towards principal with no interest?
40 to 45% of rents. And that
Okay,
is,
so 40 to 45%. So you knew
yep,
that you could bring in a round figure of about $2,000 a month.
yep. And
Yeah,
actually, what I do is I ask them, because this was a rental property, I said, what were you getting for rent? And I'm going to base it on what they were getting for rent, not what I'm going to get.
right.
So they were getting about $1,500 a month. And they said, well, it probably should be 17 to 1750. I said, okay, great. We'll go off 1750. 45% of 1750, roughly $800. And that's where we came up with that number. So even if it's a break-even cash flow, I'm actually gaining $800 a month of principal.
Because of the pay down.
Correct.
Because of the pay down. That's brilliant. That is brilliant, Derek. Derek, thank you so much for sharing your experience and your wisdom. What's the best way for my audience to continue the conversation with you and learn more about all this creative structuring and using private money?
Well, simple enough. Go to derekdombeck.com. On there, you will see links to everything I do. I do have a negotiations training out there, and I do have links to all my social media. And honestly, if any of you have questions and you just want to reach out to me with a quick question, I'm more than happy to help.
That's awesome, Derek. You are truly a go-giver. And I appreciate you so much, Derek, for joining me on the show. Thank you so much, Derek. And there y'all have it. Be sure and check out Derek's website, www.derek, and that's DEREK. Of course, all this is going to be in the show notes. But if you're listening, www.DEREK, DOMBECK, DerekDombeck.com. And you'll be connected with a go-giver that's pretty smart when it comes to these creative deal structurings. Thank you so much, Derek. God bless you. And there you have it, another amazing episode of Raising Private Money. I'm so glad you decided to join us here on this show. And let me tell you, you are only one conversation away from making a huge impact in somebody else's life. So here's how I need your help. Just think of one person that you believe that this episode can make an impact and a difference in their life, and share this episode with them. Of course, if you're watching on YouTube, always like, share, subscribe, click that bell so you don't miss out on any more of our upcoming episodes. I look forward to seeing you right here on the next episode of Raising Private Money with Jay Conner.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jconner.com/moneyguide. That's jconner.com/moneyguide and download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jconner.com/moneyguide to get your free guide. We'll see you next time on Raising Private Money with Jay Conner.